Welcome to the Deep Dive. We're jumping into the world of financial reports again, and they often tell some pretty surprising stories. Today, it's all about ASML Holding NV, doing a deep dive into their Q2 2025 earnings.
Yeah.
Our goal, as always, is to cut through the noise, give you a shortcut to understanding what really matters in these sometimes dense reports. And this one is fascinating. It's a classic beaten lower situation. The company just blows past expectations. Everyone thinks great, and then the stock drops. It's pretty counterintuitive, right?
It really is. You see the headline numbers, maybe the earnings beat and think everything's rosy, but the market often reacts to something else entirely, maybe what management says about the future. Understanding both the numbers and the narrative, that's key.
Yeah. Exactly. Yeah. And we're going to break it down using their own framework. They laid it out over 5 slides, so we'll follow that. But first, really important quick heads up for everyone listening. This deep dive is purely informational. It is absolutely not financial advice, not investment advice, legal, tax, none of that. It's not a recommendation to buy, sell, hold anything. Always do your own research, talk to a qualified professional before making any investment decisions. Okay. And also, just so you know, this report was put together using an AI model combining ASML's official release with public market data. It's designed for accuracy, but, always best to double-check things yourself.
Yeah.
All right. Now for slide 1, the at-a-glance scorecards. Let's get right into this beaten lower thing. ASML, they really did surpass expectations. Top line, bottom line, it shows pretty strong operational execution, wouldn't you say?
Oh, absolutely. The Q2 numbers themselves were very solid.
Look at this. Total net sales came in at $7,691.7 million. The analysts were looking for something around $7.52 billion. So a comfortable beat there. And then earnings per share, diluted EPS, hit $5.90. The consensus was more like, $5.15 to $7.19.
Yeah.
So a really significant beat on profit, too. The beat part is definitely clear.
Definitely. But here's the twist, the lower part. Despite those great current numbers, the stock traded down, I think it was about 6.7% in pre-market trading, and that was almost entirely down to what management said, or maybe didn't say, about the future. Specifically, they sounded cautious about growth visibility for 2026.
Right.
It just goes to show how much forward-looking comments can outweigh current wins. The market is always trying to look ahead,
That's the lower right there.
Yeah.
But let's not gloss over the present strength. The year-over-year growth is pretty stark. Total net sales were up 23.2% compared to Q2 last year.
Mm-hmm.
Net income jumped 45.1%.
Wow.
And diluted EPS up 47.1%. From $4.01 last year to $5.90 this quarter. That's a huge leap.
It really is. And notice how net income and EPS grew, like almost twice as fast as the revenue did.
Yeah, I saw that. What's driving that? Is it just efficiency?
That's exactly what it points to, increasing profitability, what we call earnings leverage. They're squeezing more profit out of each dollar of sales. 2 main things happening there this quarter. First, operating leverage. Their operating margin expanded quite a bit from 29.4% last year to 34.6% this quarter.
Okay.
So costs aren't rising as fast as sales, more profit falls to the bottom line. And second, a bit smaller but still a factor, share repurchases. They bought back some stock, reducing the number of shares outstanding by about 1.3%.
Oh, okay.
Fewer shares means the same net income gets divided up into bigger slices per share, boosting EPS mathematically.
Got it. And you mentioned diluted EPS specifically. Just quickly, why is that the one investors usually focus on rather than just basic EPS?
Good question. Basic EPS is just net income over the current shares. Simple enough. But diluted EPS is more conservative. It considers potential shares like from stock options or convertible debt, things that could become shares.
Okay.
So it shows you the EPS if all those potential shares were actually issued. It's kind of a worst-case dilution scenario, which makes it a more realistic and often preferred metric for investors.
Makes sense. All right, let's move on. Moving to slide 2, the engine of profitability. So how exactly are these expanding margins driving the profit engine?
Well, this is where you see the efficiency really kicking in. Let's start with gross margin strength. They reported 53.7% gross margin in Q2. That's up from 51.5% a year ago.
Nice improvement.
And interestingly, it was actually above guidance. The CEO, Christophe Fouquet, said it was mainly because of more upgrade business and some one-offs that lowered costs.
Ah, the upgrade business again. That sounds important.
It is. That favorable mix, getting more revenue from high-margin services and upgrades, is a big plus.
And that flows right into the operating margin trajectory, which, as you said, saw that big jump to 34.6% from 29.4%. It's a really clear picture of that operating leverage, isn't it? Gross profit growing nicely, while operating costs, R&D, SG&A, grew much slower.
Exactly.
Yeah.
It highlights ASML's very scalable business model. I mean, the R&D to develop these machines is immense, obviously, but once they have the technology, the cost of selling another system, or especially selling an upgrade or service package, is proportionally lower.
Right.
So extra revenue tends to generate a lot more profit. And that higher upgrade business isn't about cutting corners, it's strategic. They have this huge installed base of machines out there.
Like the razors and blades idea.
Precisely like the razor and blades model. Selling the machine is the start, but the ongoing services and upgrades are the high-margin, recurring blades. It gives them a steady income stream, less tied to the ups and downs of new equipment sales.
Very smart. Okay, let's look deeper inside that engine. Now for slide 3. The engine room business segment performance. Breaking down the revenue helps us see exactly where that profitable growth is coming from, right? Especially connecting back to those margins.
Absolutely. ASML basically has two main ways it makes money. First, net system sales. That's selling the big lithography machines, new or used.
Yeah.
It's the biggest chunk of their revenue, but it can be cyclical, depending on chip maker investment cycles.
Okay.
Second is installed base management. This is all the services, the software upgrades, field options for machines already out there in the factories. Sometimes they call it net service and field option sales.
Right, the blades.
Yeah.
And the numbers here really tell the story this quarter. Net system sales hit roughly $5.6 billion. That's up 17.5% year over year. Pretty good.
Solid growth, yeah.
But installed base management, that came in at nearly $2.1 billion, up 41.4% year over year.
Exactly. That's more than double the growth rate of new system.
Wow.
The installed base management segment was clearly the star performer, and it directly backs up what management said about why profitability was so strong, those high-margin upgrades and services. It really reinforces that razor and blades analogy. The long-term value isn't just the initial machine sale, it's the stream of essential high-margin services needed to keep these incredibly complex machines running optimally for years.
Yeah.
It gives them a really resilient base, a structural tailwind against the cycles in the equipment market.
Okay, that makes a lot of sense. Let's shift gears slightly. Moving to slide 4. Financial strength and shareholder rewards. Beyond the income statement, how does the company look financially, and what are they doing for shareholders?
Well, looking at their balance sheet health, one common metric is the debt-to-equity ratio. As of the end of Q2, their total liabilities were about $27.2 billion, and total equity was around $17.6 billion. That gives a debt-to-equity ratio of 1.55.
1.55, is that high?
Yeah.
Low? What's the context?
It might sound a bit high compared to some industries, but you have to remember this is semiconductor equipment manufacturing. It's incredibly capital intensive. You need massive investments in R&D and factories. So within that context, a ratio like 1.55 suggests a balance sheet that can support those necessary big investments while still managing its debt load. It seems reasonable for their sector.
Got it. And what about returning value to shareholders? Capital allocation?
They were active there, too. They announced they bought back $1.4 billion worth of their own shares during Q2. That's part of their ongoing 2022-2025 program.
Right, which helps boost that EPS number we talked about?
Exactly. And they also declared an interim dividend of $1.60 per share, so direct cash back to shareholders as well.
Okay, but here's something interesting. You mentioned management sounding cautious about the future, especially 2026. Yet they went and spent $1.4 billion buying back stock in Q2. Doesn't that seem contradictory, like saying one thing but doing another?
That is a fantastic point, and it really gets to the heart of the two competing narratives this quarter. You're right, the words were cautious about the macro outlook, but the actions spending $1.4 billion on buybacks signal pretty strong confidence, don't they? Confidence in their current operations, their ability to generate cash, and maybe a belief that their stock price is actually undervalued right now.
Oh.
So it's like they're saying, look, the external world has uncertainties we can't control, especially looking out to 2026. But internally, our business is strong, we're making money, and we think buying our own stock is a good use of cash.
So the caution is external, the confidence is internal.
That's how I read it. It suggests the caution isn't about some hidden weakness within ASML itself, but more about broader economic or geopolitical risks they can't predict. It's a really telling divergence between words and actions.
Interesting perspective. Okay, let's bring it home. Now for slide 5. The road ahead management's outlook and key takeaways. For a company like ASML, sitting right at the center of the tech world, what they say about the future, their guidance, that often moves the needle more than past results, doesn't it?
Absolutely. Future expectations are paramount in stock valuation, especially for tech leaders, and that's exactly what played out here. So looking ahead, their immediate guidance for Q3 2025 seems okay. Net sales between $7.4 and $7.9 billion, dollars, gross margin 50% to 52%.
Pretty stable.
Yeah, and for the full year 2025, they stuck to their previous forecast, about a 15% increase in total net sales and a gross margin around 52%. All seems fine.
Okay. So where's the caution?
It was all about 2026. The CEO's specific words were key. He said, and I'm quoting roughly, "While we still prepare for growth in 2026, we cannot confirm it at this stage."
Cannot confirm it. That sounds like the trigger.
That was it. That little phrase, that admission of uncertainty about growth further out, that's what spooked the market and led to the negative reaction, overshadowing the strong Q2 beat.
Right. Okay, so let's try and synthesize this whole quarter. What are the big takeaways? First, clearly a beat and lower quarter. They smashed Q2 expectations, but the stock dropped because of that cautious 2026 outlook.
Yep, textbook case.
Second, the profitability engine is firing on all cylinders. Profits grew way faster than sales, thanks to margin expansion and that booming installed base management segment.
Definitely a highlight. Strong execution there.
Third, AI demand seems to be the main driver right now. Advanced logic chips, primarily for AI, made up a huge 84% of their new orders in Q2. Shows their importance, but maybe also some concentration risk.
Could be read both ways, yeah. Central role, but dependent.
And finally, confident actions amidst cautious words. That big $1.4 billion buyback signals internal confidence despite the cautious language about the future.
Correct. The diversions we discussed. So, the final narrative really becomes a tale of two competing stories, doesn't it? We've got outstanding execution in the here and now, great sales, soaring profits, leveraging their installed base brilliantly, ASML operating at peak performance.
Right.
But then you have the second story, the one about future uncertainty. Management's prudence, their refusal to guarantee growth for 2026 because of external factors, that story ultimately resonated more strongly with investors this time around.
And that created the whole beat and lower outcome.
Exactly. It's a powerful reminder that in the market, future expectations often carry more weight than past achievements, even for a dominant player like ASML.
Well, this kind of structured look following their slides really helps get past just the headlines, doesn't it? You start to see the different engines working, the strategy behind it all.
It really does. It lets you unpack the why behind the numbers. And thinking about that strategy, here's a thought to leave listeners with. Considering ASML's powerful razor and blades model, what implications might this have for other industries where the initial sale of a complex product is just the beginning of a long, potentially very profitable relationship built on high-margin services and essential upgrades? Where else do we see that playing out?
Interesting question to ponder. Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.